Silver just printed $82, $41 an ounce in Shanghai, while New York is still flashing $74 and acting like nothing happened. That is the event. That is the break. And if you think this is just a premium, you're already behind. Because a normal premium is a few cents, maybe $1. A normal premium closes fast. Arbitrage eats it alive. This gap didn't close. It widened. That means the global silver market just revealed something it never wanted to admit out loud. Paper and metal are no longer the same product. And once that truth becomes obvious to industry, the repricing doesn't happen politely. It happens violently. Welcome back. No fluff, no long warm-up. We're going straight into the fracture that just hit the system, why it matters more than any chart pattern, and why the next move could come when liquidity is at its thinnest and emotions are at their weakest. I want you to lock onto one number and not let go. $82, 41. Not a projection, not a someday, not a thumbnail fantasy. That is what Shanghai is paying right now for real silver exposure in their market. Meanwhile, the West is still playing a paper game around $74, selling promises like promises are the same as atoms. They are not, and the market just proved it. Now I know what the reflex response is. I can hear it already. Shanghai always trades higher. Currency conversion tricks? Different contract specs? Clickbait? Good. Skepticism is healthy. So let's kill the debate with arithmetic and move on. Here's the math, in plain English, with no magic. The front-month contract in Shanghai settled around 18,740 per kilogram in local terms. Take the exchange rate, roughly around 7. Or 5 to the dollar. 18,640 divided by 7. 0.5 gives you about $2,045 per kilogram. Now convert kilograms to troy ounces. There are about 32, so 15 troy ounces in a kilogram. $2,145 divided by 32. 15 equals $80, 41 per ounce. That's not interpretation. That's not narrative. That is arithmetic. China is paying $82. 41. New York is selling paper in the mid-70s. That's a gap of nearly $8 an ounce. In a functioning global commodity market, an $8 gap is a screaming alarm bell. Because arbitrage exists for a reason. Arbitrage is supposed to be the disciplinarian. It's supposed to drag prices back into alignment. If silver is cheap in New York, a serious player buys it there, takes delivery, moves it east, sells it where it's dear, and pockets a low-risk spread. That flow is supposed to compress the gap. So ask yourself the only question that matters. Why isn't the gap closing? There are only a few possible answers, and every single one of them is bad for the paper price. Answer number 1. The silver can't be sourced fast enough in deliverable form. Numbers can exist on a screen while bars don't exist in the right place, in the right size, at the right time. Inventories can exist as accounting, but if you can't pull them when you need them, they're not inventory, they're a story. Answer number 2, the plumbing is clogged. You can't teleport 1,000-ounce bars across oceans. You have to get them, transport them, sometimes refine them, certify them, and clear them. That takes time. And time is the enemy when the premium is moving faster than the ships. Because by the time your metal arrives, Shanghai might not be $82 anymore. It might be $85. It might be $90. And your risk-free arbitrage becomes a race you can't win. Answer number 3. The market is telling you the most uncomfortable truth of all, that the West's paper price is no longer discovering price. It's lagging it. It's reacting to it. And the physical market is setting the tempo. If you've ever wondered what it looks like when paper and physical divorce, this is it. Not a press release. Not a headline. A spread so big it stops behaving like a spread. A crack that refuses to heal. Now we go one layer deeper because prices are the symptom. The cause is in the vaults. And the vault data is where this gets genuinely disturbing. Because the reason arbitrage can't just fix it is simple. The metal is leaving the system, not moving around inside it, leaving it. And once metal exits the exchange ecosystem, it doesn't magically float back in because a spreadsheet says it should. Look at the inventory trend on the Chinese side. Shanghai exchange stocks were dramatically higher a few years ago, roughly around 1,800 metric tons back in 2021. Today, they're down under about 500 tons. That's not a dip. That's a collapse. That is roughly a 70% plus drawdown in just a few years. Do the conversion, and you're staring at tens of millions of ounces that used to sit inside the exchange structure and now do not. Where did it go? It didn't go into a museum. It went into industrial pipelines. It went into private vaults. It went into hands that don't want to lend it back to the system. Because when confidence breaks, behavior changes. People stop renting metal. They start owning it. And once that shift happens, the available supply that paper markets count on becomes phantom supply. It exists until somebody asks for it. then it's gone. Now mirror that on the Western side. The same movie, different theater. Registered inventories shrink. Deliverable categories get thinner, and then you see days that make no sense unless you understand what's happening. 1 million plus ounces, leaving a major vault category in a single session. Not a trickle, a yank. That's not retail speculation. That's procurement behavior. That's someone saying, give me the bars now. Because the most important thing to understand is this. In a real shortage, the market doesn't panic because the price rises. The market panics because the metal vanishes. Price is just the aftershock. Now here's the paradox that turns the situation into a self-feeding loop. The higher Shanghai goes relative to New York, the more the arbitrage looks like free money. So more traders try to capture it. How do they capture it? They buy in the West, then demand delivery. What does that do? It drains the very inventories the West needs to keep the paper system credible. So the mechanism designed to compress the gap ends up tightening the supply that would allow the gap to compress. It's like trying to put out a fire with gasoline. You attempt to close the spread. You accelerate the depletion, you weaken the vault, you increase the fear. And fear creates premiums. This is how a premium turns into a regime change. Let's walk the loop, clean and simple. Shanghai pays $82, 41. New York paper sits $74-ish. Arbitrage sees the spread and moves in. They buy Western contracts. They stand for delivery. Registered metal declines. Now the West has less deliverable float. Less float means less ability to meet physical pulls without stress. Stress increases the risk premium. Risk premium pushes Shanghai higher because Shanghai is anchored to physical urgency. By the time the bars arrive overseas, the premium hasn't vanished. It moved, and the system is tighter than before. That's not a temporary anomaly. That's a structural feedback loop. Now the question becomes, why is Shanghai paying up like this? Is it speculators? Is it retail mania? No. This is the part most people miss, and it's the most important part. Industrial demand doesn't bargain with you. Industrial demand doesn't get emotional about overbought. Industrial demand doesn't care about your feelings. Industrial demand cares about one thing, continuity. If a factory runs out of silver, that factory doesn't have a bad day. That factory has a shutdown, and shutdowns are existential. So when industry starts bidding, the demand becomes inelastic. They buy at $74, they buy at $82, they buy at $100, because the cost of the metal is smaller than the cost of stopping production. This is why Shanghai's price matters. It's not better sentiment, it's not more bullish traders. It's a signal of urgency in the supply chain. Start with solar. China dominates solar manufacturing capacity. And solar isn't some niche demand line anymore. It's a national strategy. Here's the key shift. Newer high-efficiency cell designs are not silver thrifty in the short run the way analysts love to promise. The industry is pushing performance and efficiency. And performance costs material, which means silver use doesn't magically vanish on command. So while the West debates narratives, factories have to sign purchase orders. And when they can't get paste or feedstock fast enough, they don't politely wait for a dip. They secure metal. There are reports of manufacturers taking delivery of investment-grade bars and melting them down. Think about how insane that is. That's not normal demand. That's not healthy flow. That's a stress signal. When industrial users melt what used to be store of value form, it means the supply chain is screaming. Now add EVs and next-gen batteries to the pile. Today's vehicles already use silver across electronics, contacts, control systems, and power routing. And the more electronics you pack into a vehicle, the more you lean on high-conductivity materials. But the real detonator for future demand is battery architecture innovation, especially anything that uses silver-based composites or interfaces as a functional layer. If those designs scale, the silver requirement per vehicle doesn't increase by a few percent. It steps up. And step functions are what break markets. This is why the Shanghai print is so dangerous for the paper price, because Shanghai is closer to the manufacturing pulse. It feels the procurement pressure first. It sees the shortage before New York admits it exists. And when the buyers are factories, not influencers, they don't buy a little. They buy tonnage. They lock supply. They front-run their competitors. Because in industry, being late isn't embarrassing. It's fatal. Now let's talk about the time window we're in, because timing matters. We are in the thinnest liquidity stretch of the year. Late December into early January is when desks are lightly staffed, risk limits tighten, and order books get thin. Thin markets don't move smoothly. Thin markets gap. And gaps are where paper systems get humiliated. Here's how this can play out. One large industrial order hits Western futures during thin liquidity. Not because of a headline, not because of a tweet. Because a procurement manager decides they are done waiting. They hit the buy button for size. There aren't enough sellers in the book at $74, so the price doesn't climb a few cents. It jumps. $74 becomes $75. $75 becomes $77. $77 becomes $80. Not because anything changed, because liquidity wasn't there. Algorithms don't care about aesthetics. They care about fills. They chase the next available offer. Now, while the West is jumping, Shanghai doesn't sit still and clap. Shanghai sees the move as confirmation. Confirmation of tightness, confirmation of panic, confirmation that the West is finally being dragged, so Shanghai reprices upward too. And the gap doesn't vanish, it mutates. This is how broken markets behave. Now layer in options mechanics, because this is where things can turn explosive even without fresh news. There's heavy options interest clustered around key strikes like $75 and $80. When price pushes into those zones, dealers who sold calls have to hedge. Hedging means buying futures. Buying futures pushes price higher. Higher price requires more hedging. More hedging adds more buying. It becomes mechanical fuel, a gamma cascade. And in thin liquidity, mechanical fuel behaves like a blowtorch. This is why the next phase can be fast. Not gradual, not nice, fast. Now, a lot of people get trapped by emotional anchors. They remember silver at $20, $25, $30, and anything above that feels impossible. That's psychology, not reality. Reality is, modern tech stacks require silver in critical pathways where substitutes are limited, performance penalties are real, and redesigns take time. So the price doesn't rise until people feel comfortable. The price rises until supply and demand are reconciled. And in a shortage, reconciliation happens through rationing. Rationing happens through price, which means price climbs until someone cannot pay. And here's the uncomfortable part. The last buyer to stop paying is not industry. The last buyer to stop paying is not national infrastructure. The last buyer to stop paying is not a factory with billion-dollar throughput. The first buyer to get priced out is the discretionary buyer. The small buyer, the one buying because it's cheap this week. So if you're waiting for a gentle return to comfort, you're waiting for something the physics of the supply chain doesn't offer. Now, let's pull the camera back and say this plainly. $80, 41 yuan. And Shanghai is not a spike. It is a verdict. It is the market voting that the paper quote is late. It is the market exposing that the old system's promise, one global price, depends on the ability to move metal freely and quickly. And that ability is failing. So what happens next? There are only a few outcomes. Outcome one, the West reprices upward fast to reduce the incentive for metal to flee. That's the violent catch-up scenario. Outcome two, the West tries to manage the problem by leaning on paper pressure while the physical premium grows anyway. That's the widening fracture scenario. Outcome three, rules change, cash settlement gets pushed, delivery gets discouraged, barriers rise, because paper markets do not like losing, and when they can't win on metal, they win on contracts. They change contract behavior. They alter incentives. They do anything to prevent a visible default event. But here's the thing. Even if they change the rules, they can't change the periodic table. They can't change industrial necessity. They can't change the fact that Shanghai is already paying a different price for the same element. And that's why this isn't just a trade. This is about who ends up with the metal and who ends up with the promise. Let me ask you something, and I want you to answer honestly in the comments. If you were running a factory that loses millions per day when lines stop, would you wait for silver to pull back? Or would you lock supply at any price and sleep at night? Second question. Do you think the West closes this gap by pulling Shanghai down or by getting dragged up? Because one of those is fantasy and the other is history. Now I'm going to give you the most important warning of this entire breakdown. The next few moves can be psychological warfare. You will see sudden paper drops that look like the end. You will see headlines that claim the premium is normalizing. You will see talking heads telling you it's overheated. They will try to create motion sickness, because volatility is the last weapon when fundamentals turn against you. But here's the filter that cuts through the noise. If the paper price dips while physical premiums stay elevated, the dip is not relief. It's a signal that paper is being used to shake weak hands while the real market keeps bidding behind the scenes. Watch the gap, watch the vault trends, watch the behavior of delivery, not the behavior of opinions. Because opinions don't power solar lines, bars do. Now, here's the core takeaway, boiled down to one sentence. The global silver market is no longer unified, and the side that has urgent physical demand is already setting the real price. That's why $82.41 matters. That's why this spread matters. That's why the word arbitrage is suddenly failing to do its job. And that's why the next repricing event might not ask for permission. It might arrive overnight, in thin liquidity, on a mechanical options squeeze, with vaults that are already lighter than they should be. So don't blink, because once a market shows you a fracture this obvious, the next step is rarely a gentle patch. It's a snap. If you want updates like this without the fluff, subscribe. Short, simple, subscribe. And drop your answer to those 2 questions in the comments, because I'm watching what people think happens next, and the crowd is usually confident right before the market does something savage.